Well, welcome. This is the final SDRAFocus webinar for the current SDRA Safeguard program year, which ends on June 30th. Our next year begins July 1st. We'll be continuing a discussion today that started with the newsletter for May about personal benefit rules. But first, I just want to review a little bit about what's gone on this year, that's important highlights. And then we'll go into a summary of the personal benefit rules, and then we'll spend some time giving some examples so that people can understand on a fleshed out basis how these rules work. If you have any questions, please feel free to get in touch with me. Remember, you have the first call program, the first call service. We want you to call us first before you make a mistake. And you'll see why when we go over the personal benefit rules and the examples today, because it's very easy to make a mistake and not even know that it's occurred. So this year, some important developments have occurred. IRS, for example, issued some new guidelines for self-certification to simplify the 60-day rollovers. A lot of people decide that they want to move between custodians, or they want to do something with their retirement account for less than 60 days, so they take it out and then they do whatever it is they're going to do, and then they roll it back into an IRA. Unfortunately, that is a fraught process, because if you miss the deadline, you have to get special dispensation from IRS, and the custodians that you roll the money to don't always know whether it's actually a qualified rollover or not. So there's a lot of confusion that occurs, and sometimes they ask for certifications from IRS and things like that. So IRS came out with guidelines whereby the IRA owner can self-certify that the transfer of their IRA funds from one custodian to the other through a 60-day rollover is a qualified rollover, that there's been no mistakes, that it's on time, and all of that. That's a good thing. IRS has actually done a good thing when they did that. So we also discovered, however, that there was a lot of client confusion about how to do valuations, even in single member LLCs, because of course, beginning in January of each year, the custodian wants you to provide valuation information about the holding, meaning LLC interests, that the account has, because the custodian has to report the value of the account to IRS, and also has to report distributions. So they want to know what's going on with your account, and they want to know what the value of the holding is, if it's an LLC interest or whatever it might be. They don't really have the ability to value it themselves, and so they look to the IRA owner to provide that information. So in December, we did a webinar, for a SDRAFocus webinar on valuation. And as it turns out, almost coincidentally, the GAO came out with a report. And I should mention that we also did a similar presentation for Pensco. I believe it was in February. They found out about the webinar and asked us to do it for them. So in December, the Government Accounting Office came out with a report. One might say that it was critical of IRS for failing to give enough guidance to self-directed retirement account owners about valuation of PTs and some other things. But IRS responded saying that they were working on the various different things that the GAO had reported. One of the key elements of the GAO report had to do with statistics about the industry, how many custodians there are, how many accounts there are, how much assets there are in those accounts as far as they can tell. And so that was very interesting that way. But a key element of it was that they said that IRS needed to provide IRA owners, self-directed retirement account owners, with more information and more guidance on how to value their special assets, because they're not easy to value, and how to report the values. And also they suggested that IRS should come out with more information about prohibited transactions for self-directed retirement account owners, because they can get really into trouble and it's a big risk. You can really disqualify your account. So it's a very interesting report. The SDRAFocus guide for February had a link to it. I think also February and March had a link to the report online, so you can go read it yourself. We also provided information about annual reporting on taxes and expenses. There are various custodian filings and deadlines that we have to do. The custodians issue Form 1099 for distributions at the end of January, and they report them to IRS at the end of February, and so it's important for people to actually review those. We talked about how those should be reviewed and what's on them. And then valuation information is reported to the custodians by March 31st, and they have to report the valuation information that they have by May 31st. Sometimes they get extensions, but that's the way it is. We also provided some information on how the expenses should be dealt with, both from an income tax point of view and deductibility, and also from a prohibited transaction point of view, because there are some expenses that you should not pay from your own, relating to your self-directed retirement account, that you should not pay from your own funds. And there are some that can be paid from either your self-directed retirement account funds or your own funds, and some that must be paid from your personal funds. So we put out some information on that in April. So we hope that you find this information useful, and we would very much like some feedback on what you think was good, what you think was bad, and so we can improve our SDRAFocus guide and our webinars for next year. So let's get back to the personal benefit rules. As you know, it was the topic of the in-depth article for the May SDRAFocus guide. And it was, what we did was we talked about the basic principles of it, and said in this webinar we were going to try to flesh those out. So let's talk briefly about the basic principles. The personal benefit rules are in two specific subsections of 4975C1, and that's C1 is where all of the prohibited transaction rules are listed on the statute. And the ones that we're talking about are the ones under D and E of that subsection. So it's the transfer to or use by or for the benefit of a disqualified person of the income or assets of a plan. And of course, as the IRA owner, you know you're a disqualified person. And it's an act by a disqualified person who is a fiduciary, whereby he deals with the income or assets of a plan in his own interests or for his own account. Now, every self-directed retirement account owner, because they have fiduciary authority over their account, they have the ability to decide how the assets are to be invested. They fall within the definition under the statute of fiduciary, so both D and E always apply to self-directed retirement account owners. So note, however, that E does only apply to fiduciaries. So that's important because disqualified persons can be just about anybody in the family or a family member of a fiduciary, but fiduciaries are specifically defined. So here's some important points on this. The first is that ignorance is no excuse and good intentions don't matter. If you make a mistake on your self-directed retirement account in a prohibited transaction, particularly with the personal benefit rules, you can disqualify your IRA, your Roth IRA, your simple IRA, and accounts like that. You won't disqualify a solo K because the disqualification rule does not apply to retirement accounts that are not under Section 408, and a solo K is under Section 401K. It's a particular type of 401K or profit sharing plan. So you don't disqualify a 401K merely by committing a prohibited transaction, but most of our clients have self-directed retirement accounts that are IRAs or Roths and of that kind, and so violating the personal benefit rules can disqualify the account, and you can do it without even knowing you did it. So again, you can violate these rules even if you don't know that you're doing it, and you can do it by mistake, or you can do it unintentionally. Another important aspect of this is that conflicts of interest between you and your retirement account matter only if they actually arise. Under ERISA, and ERISA applies to qualified plans, not to most self-directed retirement accounts that are IRAs, and it doesn't apply to solo Ks. Under ERISA, fiduciaries have a lot of rules relating to conflicts of interest that arise out of the fact that all fiduciaries in qualified plans are trustees of a trust for multiple beneficiaries. And so they have borrowed under ERISA the principles that apply to trustees of trusts. But for Section 4975, those rules don't apply. So you can have a conflict of interest with your retirement account, but it only matters if it actually comes up. If there's actually a potential conflict of interest, doesn't really matter. It's just when there's an actual conflict that arises, that's when you have to take steps to avoid violating the personal benefit rules. Because of course, if there is an actual conflict of interest between you and your retirement account, and you resolve it in your own favor, you are essentially using your retirement account in your own interests and for your own account, which is a violation of subsection E. So it matters when an actual conflict arises, but we don't really have, the closest thing we get to a conflict of interest rule under the prohibited transaction rules in Section 4975 is E, that says that a fiduciary can't use the account in his own interest or for his own account. Another thing that is easy to forget, and that is that the prudence of the investment that you make doesn't really matter. Sometimes people want to argue that the action that they took that's being alleged to be a prohibited transaction was a really great deal for the retirement account, and under Section 4975, that just doesn't matter. It actually is a good thing in most cases, because it also means in Section 4975, you don't violate anything by making a bad investment. Under ERISA, of course, there are prudence standards that the trustees have to follow, but those rules don't apply under Section 4975. So you can't disqualify your account by doing an imprudent investment, but doing a wonderful investment also doesn't get you away from having violated the rules if you have. Now, you also can violate the personal benefit rules, it's important to note, even if no assets pass between you and your retirement account. So you can have things going on in your own life and things going on with your retirement account, and never the twain shall meet, but they can also be coincidental, or they can also be parallel, and one can affect the other. So there are lots of ways, both subtle and not so subtle, that you could benefit personally from actions of your retirement account, even when no assets are transferred between you and your retirement account. It's also important to note that there are certain types of benefits that you can get from a transaction called incidental benefits that don't disqualify your account, that are not prohibited transactions. Now, the whole idea comes from the original derivation of Section 4975, which is another statute which is designed for private foundations, and that's Section 4941. That statute was passed a few years before Section 4975, and in it, the regulations under it and in the statute, it indicates, and the Department of Labor has also followed this up, that in a private foundation context, you can get a benefit out of making a contribution to a charity or a private foundation because of the notoriety that you get, for example, from having made the contribution. But that is considered an incidental benefit. There's actually an IRS regulation on it under Section 4941. that says that that kind of benefit, having public recognition for the fact that you made a contribution to the charity, is not a disqualifying event. It's not a prohibited transaction. So you can have incidental benefits. The problem is that in this context, there really aren't any cases and there aren't any regulations that tell us what an incidental benefit is under Section 4975. It just hasn't been any cases. So we might say that something might be an incidental benefit, but it's going to be up to the court on a factual basis to decide whether it was incidental or not. And one of the cases we're going to talk about today, the court actually couldn't figure that out. So we don't know from the facts that were before it, we don't know what an incidental benefit is in this context. So we probably don't want to try to rely on claiming that something is an incidental benefit. It might be a straw that we pull if we have nothing else to rest on. So let's talk a little bit about examples. Now, there are two primary danger areas that you can get into these rules with. First is when your retirement account makes a loan to an entity in which you individually have invested. And the second is when your retirement account co-invests with you in common with you in some kind of an investment. So the first example, now these loans are loans that are not to disqualified persons. In other words, if an LLC is 50% or more owned by you as the retirement account owner, the LLC is a disqualified person. So that loan is going to be a prohibited transaction under another subsection of Section 4975. It's very clear you can't make loans between retirement accounts or provide credit between retirement accounts and disqualified person. But in this case, you own only 20% of the LLC, and the other 80% of the equity is owned by 10 unrelated third parties. Let's say that that's 8% each, which means that you are probably the largest individual owner, but again, you don't own 50% or more. In this example, all voting is pro rata and a majority of the votes controls. It's not a situation where the manager of the LLC is in control of all the business decisions. And the LLC owns undeveloped land held for potential sale to a developer. But it's been holding that land for a while, and the capital that was originally put in by the members is pretty much dried up. And so the LLC needs to get a loan to tide it over and cover the costs until a buyer is found, or a developer is found that wants to develop the property. So you plan to make a loan to the LLC and cover its taxes and insurance costs for about 3 years, and you're going to get security. The loan is going to be secured by the property. You're going to get a mortgage on the property. You also believe that the loan is on the same terms as the banks would be offering to the LLC at the same time. In other words, it's on the same kind of terms similar to market terms that would be otherwise offered by independent lenders. So can your SDRA make the loan to the LLC? Well, in all of these cases, it's an issue of what are the facts and how do the facts cut. There aren't really no bright lines. The courts, when these things are considered, will consider all the facts that are presented before them. So is the LLC a disqualified person? No, it's not a disqualified person because you don't own 50% or more. Is there a personal benefit rule violation? There are arguments both yes and no. So the yes arguments would be, one is, suppose the borrower defaults, then you have a conflict of interest. There's a potential violation of C1E. So just because there's a potential violation doesn't mean that there is a prohibited transaction. It actually has to arise. So that is, an argument that you maybe shouldn't make the loan. But again, you're an investor in it, and you figure pretty much that it's going to get paid off anyway. And another argument is that the terms are more advantageous to the borrower than the borrower could have gotten from independent lenders. Now, you said that you thought that it was comparable to what they could have gotten from independent lenders. But suppose IRS argues that it's not, that the terms of the loan are more advantageous to the LLC than it could have otherwise gotten. And that cuts towards making the argument that you as an individual owner got a personal benefit by the loan because you didn't have to, it didn't cost you so much. It didn't cost you as much in terms of interest that a loan from an independent lender would have. So indirectly, you have gotten a benefit from the loan. That's the argument. Another argument that there was a personal benefit is that the borrower doesn't have to deal with independent third-party lenders, which can substantially reduce the costs because, after all, you know a lot more about the land and the deal and the potential for it than a lender might. They're going to charge money for points up front for having underwritten the loan and all kinds of things like that, whereas you already know that. So maybe you're not going to charge that. So by not having to deal with independent third-party lenders, that can be a benefit to you as well because it's not such a hassle and you don't have to go through the application process. The no arguments are the converse of those. You could, for example, appoint an independent party to hold the promissory note, and if there is a default, collect it for their self-directed retirement account. You'd have to do that irrevocably, but again, if a third party holds it, they're going to exercise independent authority over, or independent judgment over whether the note gets collected and how, and you're not going to have a conflict of interest at that point, at least theoretically. Now, not dealing with independent third parties was one of the things, and that we could say is an incidental benefit. So if it's just more convenient, it could be considered an incidental benefit. And then, of course, if the terms of the loan are no more favorable than were available from independent lenders, well, that means that you didn't actually get a benefit because you would have paid the same amount, your share of the interest, if you'd gotten a loan from someone else. So the question is, if you're in court and IRS is arguing that you disqualified your account, who has the burden of proof? Well, this is the case of the Rollins case. It's a leading case that came out in the early 2000s. And what Mr. Rollins did was he was the trustee of a profit sharing plan for his accounting firm. It was a qualified plan, but he was the trustee, and independently he had made some investments in several LLCs that had undeveloped land with a bunch of other people. His highest percentage ownership, I believe, was 34%. And so he made loans to various different of these LLCs, and he did them on what he thought was a commercial basis, consistent with commercial practices at the time. And IRS came along and said, "Oh, no, we don't agree. You got a personal benefit by making those loans." So it ended up in the tax court because IRS wanted to assess excise taxes against Mr. Rollins for having violated the prohibited transaction rules. Remember, this is if he has a qualified plan, and that was what he did. It doesn't actually disqualify the plan unless IRS comes along and says the plan is not being administered as a qualified plan. That's a whole other different set of issues. But in this case, they were trying to assess excise taxes on Mr. Rollins as the trustee who had done these loans because they claimed that he had gotten a personal benefit. So what happened was that the court considered the analysis, and they said that they didn't have enough information to decide whether he got a benefit or not. They couldn't tell. He may have gotten an incidental benefit from having the convenience of not having had to apply to independent third parties, or he may not have gotten an incidental benefit. Maybe it was a true benefit. And they didn't know whether the terms of the loan were more favorable than otherwise available because they considered the evidence before them as insufficient to make that determination. And because Mr. Rollins in the tax court had the burden of proof, they held for IRS and said that he had committed a prohibited transaction and owed the excise taxes. So Mr. Rollins thought that he was complying with all of the rules, and he got trapped by getting a personal benefit that he didn't really perceive. So that's a risk that we all know. That's one of the first cases of the personal benefit rules in this context. So another example, and now getting into co-investment, sometimes people decide that they want to own a piece of real estate as co-owners with their retirement account. So you can do a joint ownership. In most cases, you wouldn't really call it a joint ownership. It would be a tenants in common. So in this case, you and your retirement account purchase real estate together, and 55% of the purchase price is provided by you, 45% is provided by your self-directed retirement account, and you hold it as tenants in common. So, one question that comes up is the apportioned ownership of a piece of real estate a per se violation? Are you getting a benefit from having co-invested with your retirement account just by having done that? And if you did get a benefit, how did you benefit from the self-directed retirement account's co-ownership with you? Well, and another question is, could you have purchased the property without the self-directed retirement account's investment? All right, so that's a factor that might weigh about whether this is a prohibited transaction or not. And is there any inherent conflict of interest by the fact that you're owning this property together with your retirement account? If you own property as tenants in common with another person, there's often an inherent conflict of interest, but no actual conflict arises until later on. So that might be something that came up. So what this is what we call is a 2014 bankruptcy case called In Re Cherwenka. I call it Cherwenka case. And in it, the bankruptcy court held first that apportioned ownership is not a per se violation as far as they were concerned. This is one of the district bankruptcy courts, not a very high court, but it's the first one that seems to have held that. And the problem was that the creditors offered no proof that Mr. Cherwenka received any personal benefit from having made the co-investment. What the creditors are trying to do is they were trying to say that the IRA's investment in the piece of property had disqualified the IRA, so the IRA was subject to claims from the creditors in the bankruptcy that Mr. Cherwenka was going through. Mr. Cherwenka, on the other hand, was claiming that the IRA was exempt from claims in bankruptcy under various provisions of the bankruptcy code, and because it was his, it was exempt from claims of creditors anyway. So that's what Cherwenka was arguing. He said it's a qualified IRA and the creditors can't get it. And the creditors were saying it had been disqualified by having made the co-investment with Mr. Cherwenka himself. But the court said that because the creditors had not provided enough proof that there was actually a personal benefit, and the creditors had the burden of proof on that, they held for Mr. Cherwenka. So Mr. Cherwenka won. His retirement account remained qualified. It didn't get divided up in the bankruptcy, and that was a exact opposite to the burden of proof that was in the Rollins case. So example 3, this is what I call the SDRA tag-along. So suppose you want to invest in a pooled investment fund because you like the returns. There's a lot of private investment funds that you could invest your self-directed retirement account in. They are investment funds that invest in publicly traded securities and other types of investments, but it's a private investment to own the security that is issued by the fund. So you found one that's getting really great returns and you'd like to invest in it because you like the returns. You also want your self-directed retirement account to invest as well because you want it to get the benefit of the returns. There's a little bit of a problem though. The minimum investment for the fund is $5 million. Now you have that in your own investment pool. You're fairly wealthy, but your SDRA doesn't. SDRA doesn't have enough to qualify. So what you want is to have your self-directed retirement account tag along with your own investment. So you establish an LLC to pool your money with your self-directed retirement account so it can make the investment along with you. So you put in $4.5 million. Your self-directed retirement account puts in another $6 million, so you're up to the $5 million. You're over the $5 million minimum, and now your self-directed retirement account can make an investment in this pooled fund. Now, you're the manager of the LLC, but you're not being compensated. And as a matter of fact, you're not really exercising very much authority or investment control over the investments in the LLC, because all it's doing is buying an interest in the pool, the fund. So the LLC invests in a larger investment pool. So is this a violation of the personal benefit rules? Well, there is actually a Department of Labor advisory opinion from 2000 called 2000-10A. And the first thing that the Department of Labor said was that absent some evidence of personal benefit, then it is not a prohibited transaction to co-invest that way. The problem was that the fund was one that was managed by Bernie Madoff. And I guess you can say that the investment itself didn't turn out too well. Fortunately, under Section 4975, there was no prudence issue. And so the Department of Labor was asked in a request for an advisory opinion whether that was okay to put that pool together. And in this particular case, it was Fetzer family, and it was a bunch of family members and some other people that were somewhat related to them, but not related under the code. They wanted to put all the money together and meet the minimum that way. And the IRA funds went along and tagged along with everybody else's. So they wanted to make sure that they weren't committing a prohibited transaction by doing that. And the Department of Labor said no. So, but hold that in mind for a moment. Suppose that the SDRA owners in the prior two examples, that's the Cherwenka case and the case about the advisory opinion, didn't have enough retirement money to make the investment themselves, but could do so if they added SDRA funds. So in the Cherwenka case, let's assume that Mr. Cherwenka had only enough money to buy his 55% of the property, and he had to, in order to get the property, he actually had to use his retirement account funds for the other 45%. And in the pooled investment fund, let's say that it's reversed. The IRA has plenty of money and it can invest, but the IRA owner can't. Or in another, let's say that none of the investors in the LLC have sufficient funds to meet the minimum investment for the pool, but together they can. So is the IRA doing what we call enabling under those circumstances? And so what's happening in that kind of circumstance is that the IRA owner is receiving a personal benefit from the co-investment because they couldn't otherwise make the investment. So what is the personal benefit? Well, you couldn't make the other investments, so you've been enabled. And the question then is, well, is this an incidental benefit? Well, let's take the Kellerman case. And it may be an incidental benefit, or it may not be an incidental benefit, but a clear case where it was not an incidental benefit to co-invest is the Kellerman versus Rice case. This again is a bankruptcy case. It occurred in 2015. It actually was a case that was appealed to a higher court. And the facts are these. Mr. and Mrs. Kellerman were developing some real estate, and they had a bunch of lots, a bunch of parcels, and they found one parcel that was needed in order to get access to a few of them for egress and for public utilities and that kind of thing. And so they wanted to buy that other parcel, but they were kind of stretched out, so they couldn't. And what they decided to do was to use Mr. Kellerman's IRA. So they formed an LLC. 50% was to be owned by the Kellermans, and 50% was, well, by an LLC that was owned 100% by the Kellermans. And the other 50% was to be owned by their retirement account. So they made the investment, the LLC purchased the property, the IRA put the money in to purchase the property and some other things. And then the Kellermans went bankrupt. And so what the problem was that in the operating agreement for this LLC that they had with the retirement account, it specifically said that the Kellermans were not required to put in their half of the capital until after the property was developed, until the development was finished. Does that sound kind of odd to you? Well, that was what they had in their LLC. So the only money that actually came in before the development was completed was money that came from Mr. Kellerman's retirement account. And the court held that, you know, that was the ability to use it that way, even though the LLC said it was 50% owned by the Kellermans, was really just a personal benefit. As a matter of fact, what they said was that the Kellermans were both they were getting a personal benefit under subsection D, but they were also using Mr. Kellerman's retirement account on their own account and for their own benefit as a fiduciary. Mr. Kellerman was a fiduciary. As a matter of fact, he made the mistake in testifying in the court, in the lower court, that he called the transaction with the IRA a loan, which in fact, in substance, it really looked like a loan. The Kellerman case illustrates that, yeah, you can have a co-investment with your retirement account, but if you kind of finagle things with the agreements so that things are a little bit weird, or so that you're actually going to get along with your retirement account bearing the burden of the investment, that's going to be a personal benefit. So that goes along with a statement in the advisory opinion that I mentioned before. That's opinion 2000-10A, not 200-10A. And that is that what the Department of Labor said, a fiduciary must not rely upon and cannot be otherwise dependent upon the participation of the IRA in order for the fiduciary, or persons in which the fiduciary has an interest, to undertake or to continue his or her share of the investment. So what that is it's saying that your IRA cannot enable you to make an investment. You have to be able to do it independently of your IRA in order to co-invest with your IRA. And that means that otherwise you're going to be getting a personal benefit. You'll be violating the private transaction rules. So let's take another example. Let's say that you invested a few years ago, non-retirement funds, with others in a real estate project. But as time has gone by, the property has become over-leveraged. Maybe you took too much money out, maybe the expenses were higher than was expected, so you borrowed more, the LLC or the entity borrowed more than was necessary. So the manager, and that's not necessarily you, says that they can't find a buyer for the property, and so more capital is needed in order to make ends meet and to keep the property from going under, and defaulting on the outstanding loans. So the manager announces that the company is going to offer a new class of equity in the entity. And so you decide to invest the SDRA funds instead of your own personal funds in that new class of equity. And after the new equity comes in, and by the way, there are other investors who invest along with your SDRA funds, but you don't invest your personal funds. But after a while, the new equity comes in, and the property is again on a solid footing, and later it sells at a substantial profit for all of the investors. So, is that a prohibited transaction? Is there something in there that violated one of the personal benefit rules? So here's the factors in your favor. Let's assume that you have sufficient personal funds to buy some of the new equity offering yourself. But essentially what you're doing is you're saying, well, I'd rather have this profit in my IRA or my retirement account rather than put it into my personal after-tax money and pay income tax on the profits. There were also plenty of other interested investors, but the existing owners had the first chance to buy, and the new offering from the LLC is a great deal, and with preferred returns, and you want to take advantage of the returns in your SDRA. So there are other factors that are against you, that could be against you, and they could be different facts. So suppose you did not have sufficient personal funds to buy your share of the new equity offering, and the equity offering is not available to non-owners, so only the current owners have to put it in. So The funds are coming in essentially as a call or an assessment by the LLC on the owners. And the owners are given the option, instead of putting in their own funds, to put in both retirement and non-retirement funds. So then subsequently the property becomes self-sustaining as a result of the new capital and is sold at a profit later. So your SDRA's investment enhanced the value of your original investment, isn't it? So in other words, you come into the situation with your self-directed retirement account making the investment at a disadvantage. With the property being over-leveraged, it's probably not worth as much as it subsequently is when it gets the extra capital and the cash flow. And so the appreciation of the value overcomes the cash flow problem. And so the value of your assets, your personal investment, was enhanced by the addition of the new capital. And oh, by the way, I could also say that could happen if it were a loan, a subsequent loan. Even if you're not a disqualified person, if a subsequent loan from your self-directed retirement account to the entity or the LLC enables the LLC to continue on a profitable basis, well, you're getting a personal benefit. It's increasing the value of your investment. So let's take example 6. Suppose a real estate developer, well, let me just go back a second. What if it's in the middle here? And this is the real kind of thing that you might run into. Suppose you do have sufficient personal funds to buy the property, but it's only offered to current owners, and it does come in as a capital assessment, all right? And you decide that you're going to use your retirement account. The result of the investment by your retirement account indirectly is still that you have increased the value of your original investment by virtue of the fact that it has now become more viable. Your interest in the entity has now become more viable, and subsequently it's sold at a profit. So again, even if you had personal funds that were sufficient to buy it, there are circumstances under which you could end up with a prohibited transaction because you got a personal benefit that you really weren't seeing. So let's take example 6. And this gets a little bit more confusing than it was before. So now we have a real estate developer who proposes that there is a property that's available for development, commercial development, that will result in state and federal income tax credits. A bank has approved the purchase of the property by an LLC with a secured loan. The deal will be structured as an LLC with 2 classes of units, A and B. The A units will get the tax credits allocated to their owners, and the B units will not. They don't get allocation of tax credits. So what are the hazards here? Well, can you buy the A units and have your SDRA buy the B units? Well, let's see. I guess that depends. Can your SDRA take advantage of the A units? Well, probably not. Typically, tax credits are used against other income, and in the self-directed retirement account area, typically that's not possible. If it's a leveraged deal and there's unrelated business taxable income or debt financed income, it's possible that the SDRA could use the credits to offset the income from that investment, but in most cases, your SDRA isn't going to be able to take advantage of the A units, so it's going to buy the B units. So will both the A and B units share the profits equally? Or do the B units have a profit preference? Well, if they share the profits equally, and the A units on top of the profits gets the tax credits, then you are getting a benefit that your retirement account is not getting on a prorated basis. And so you're probably getting a personal benefit from having financed your ability to, with your retirement account, the ability to get tax credits. So suppose there is a profit preference. If the B unit profit preference comes in, that's a way to say, well, okay, we've compensated the B units to make things equal. Yes, the investment in the B units enabled you to get your tax credits, but in fact, the tax credits had an equal value to the preference that the B units have as an investment. So there's really no personal benefit. It all would have been the same anyway. So, but suppose, here's the problem. if the B unit profit preference isn't the same as the value of the tax credits to you, are you still getting a personal benefit? How do you calculate how to determine what the profit preference is? Tax credits can have different values for different people. You may be able to use tax credits more than the tax credits of the other developer. And so, you might have a problem there, even if there is a proper preference for the self-directed retirement account that's owning the B units. All right. And that could also occur if there's a loan as well. So it's something to watch out for. The legislative history of Section 4975 cites an example where the use of retirement funds to manipulate the stock values in order to increase the value of the holding of stock of a disqualified person, the stock holding of a disqualified person, would be considered a prohibited transaction under the personal benefit rules. That's right in the legislative history. Congress anticipated that kind of thing, and that's why they had those rules in there. And that example, as a matter of fact, is exactly the same example that was used in the legislative history of Section 4941 for private foundations and their prohibited transactions. So let's do a summary. The personal benefit rules are a hazard that can go unnoticed by you, and they can go unnoticed for years. All right, so let's say that you did this, you had a transaction in which you received a personal benefit. You didn't know that you got a personal benefit, or you didn't know that what you were getting was a personal benefit. And you have a non-qualified plan, and it's under Section 408, it's an IRA, and it gets disqualified automatically by having the privileged transaction. But you didn't know. So you continue on as if the retirement account is tax exempt, and you do this for 5 or 10 years. And the retirement account continues to earn money and that kind of thing. Then IRS audits you a few years later and says, oh, now wait a minute, let's take a look at this self-directed retirement account. And they decide that you got a personal benefit from the transaction, those 7 or 10 years ago. And so all that income that your retirement account was disqualified, and so in that year you had ordinary income equal to the value of your retirement account. But in addition, all of the income that the account earned in the interim years was also taxable income to you that you did not report. So you get underreporting penalties, you get late filing penalties, late payment penalties, and as a matter of fact, that kind of situation can end up with more money being paid out in taxes than it actually was in the retirement account itself. So this is something to watch out for. And that's one of the reasons why we try to have the education program here. So prohibited transactions can occur under these rules if you receive a benefit even when no assets are transferred between you and your retirement account. So again, these actions can occur in parallel. If you're indirectly receiving some kind of a benefit from the action of your retirement account, that's a violation. They come up most with loans to entities with SDRA owners and investors and co-investments, and those are the typical examples. And finally, it's important to use the first call service. Remember, as SDRA Safeguard owners, SDRA Safeguard members, you're entitled to call us on the phone and ask us any questions you want. We want you to call us first. That's why we call it the first call program. Call us first before you make a mistake. So when you have any kind of a question, or when you're in doubt, when you think there's a vague possibility that you could be running up against a personal benefit rule, please call us so that we can analyze it and talk to you on the phone. Most of the questions that we get on the phone can be answered fairly easily. We're happy to take the time to explain things to you. So please do call. So that is our program. That is our SDRAFocus webinar for June. Again, thank you very much for participating in the program. I hope that the information that you're getting from the program is useful and helpful. We'd love to get some feedback. I may be sending out a survey to you to find out what your feedback is for the program this year so that we can make improvements next year and move along. So again, we love your feedback. Thank you very much for attending. And we wish you a happy and healthy and very enjoyable summer.